This morning, I just wanted to talk about one of the most pervasive or most emerging themes of 2021, and that's ongoing strength and momentum in the commodities market. It was an absolutely stunning week last week in various commodities, and there's some fascinating developments playing out both in the financial market and the physical markets for some of these commodities, which is all adding to the momentum. So this trade, I guess, is what we discussed this time last week, which was Aussie dollar weakness. Just wanted to touch on some of the key points for mine that I'm taking away from looking at this current cycle versus some of the cycles in the past, because there's a growing number of capital allocators out there that do want to perhaps dream of this perhaps turning from what is already a very good cycle into potentially a super cycle. So just stepping through some of the key issues driving commodities at the moment. And we talked about $8 weakness last week as a function, $8 strength last week as a function of US dollar weakness. And I've got a couple of charts showing you some perspective on further US dollar weakness. And the events of last week really do add momentum to this trade or put more downward pressure on the US dollar. So Biden and the Democrats being able to control the Senate enables them to have a stronger mandate to enact change. And we heard this morning about stimulus rolling out in the US, and the worse COVID gets over there, the greater that stimulus needs to be. So the more liquidity that can get pumped into the system through QE-style stimulatory measures by this government, this left-leaning government in the US, simply adds to the amount of liquidity in these markets available to bid up assets like commodities. So that's putting pressure on the US dollar, which is also fueling that trade as the reparation of the financial market sees capital exit the US. And arguably, if Biden's going to target the tech stocks, you're also going to see that drive capital or flow out of the US dollar into riskier assets, if you like, in emerging markets, including commodities and including the Australian dollar. So that US dollar weakness trade looks like it's got another 10+% of weakness to go. And if you look at the correlations or the inverse correlations with metals and energy, then you're looking at maybe another 15 to 20+% upside in some of those markets. And those charts do show those relationships pretty clearly. Now, we've talked a lot about where commodity prices are relative to their recent highs. And last week, I think nickel hit about a 5 or 6 year high. So at the moment, you've got iron ore, copper, and nickel all at 5 to 7 year highs at the moment, even 5 to 8 year highs. Gold's still trading quite strongly, and you've probably heard me bang on about having a look at those commodities that are lagging way behind. And we've talked about oil and thermal coal and coking coal, and notably a few of those commodities are really starting to rally now. So thermal coal, $85 versus a low of 46 only about 6 or 7 weeks ago. That's well over the halfway point of its recent sort of trading range. Aluminium's been stronger, and Brent oil, as you heard in the morning wrap, we're at I think $55 now, closing on a year sort of 12-month high. Yet Brent and coking coal are still lagging well behind the other commodity markets. So it does feel like those other metals do have limited upside, but I've also shown you a chart in the pack this morning about where every commodity sits relative to super cycle highs. And if you look at the whole spectrum, nothing's trading at its high. Gold is the closest to its super cycle high, but all of iron ore, copper, the base metals, through down to coking coal, at the lower end of the spectrum, I guess if you take a look at nickel as an example, we're about $8 roughly versus a low of $3.50, and we have seen a high, believe it or not, in the last super cycle of around $24.50. So I'm not saying this is going to happen, but there are a growing number of capital allocators and also speculators out there who do want to place bets on some of these commodities making much higher gains from here. And if you looked at from the bottom up, those that are looking most interesting, you've heard us talking about them, coking coal, uranium, nickel, thermal coal, Brent oil are in the five, cheapest sort of commodities relative to that last super cycle. Again, not guaranteeing we're going there, but the momentum is certainly building through some of those dynamics I just mentioned a minute ago. Just some other interesting developments. I've got a chart in here showing you the energy market complex. I've got LNG, Brent oil, and thermal coal pricing. And you might have missed the news last week, but LNG into Asia has now re-rated tenfold from its COVID lows in March. So we're at around $20 per million BTU. That's pretty much fundamentally driven, and it's driven by freezing weather in North Asia, and it's demand led. So it's nothing to do with it's less to do with financial markets and currencies and supply even. It's a real demand led recovery here, and that's dragging up the prices for other forms of energy, including thermal and Brent. So the point I wanted to make on these slides is that fundamentals in some of these really beaten up markets can change quite quickly in commodities, and that's exactly what we're seeing in energy. What really stands out is that Brent is still lagging behind, and the energy-facing equities are among the worst performers still on our market and the worst laggards. So this is where we like to go hunting for opportunities. I've got a slide on this pack showing those equity market segments and where they sit relative to their super cycle highs and lows. And again, where you should be fishing is, ASX 300 energy, small resources. Believe it or not, we've had this amazing rally. BHP and Rio are at record highs. Gold stocks are quite strong, but the small resources market is still only about 1/3 of where it got to during the super cycle. And there are some reasons for that, which I won't go into much. I do explain why that's the case in these slides, but I've got a good chart of the juniors versus the large cap mining space in here and why that separation has split out. But I guess a comment to make about risk-seeking capital. This segment has had a challenging few years, and there's been some false starts on things that emerge. But if we get a proper if the tech sector hits some turbulence due to Biden or US difficulties or regulation or anything like that, then that risk-seeking capital has a very long history of seeking returns in other segments. And until recently, it's been biotech, crypto, cannabis, and other things. But junior resources has been for generations a destination of risk-seeking capital, and it's a segment that can certainly play catch-up in 2021, as Chris Brown has been talking about. I've got a slide in there about equity market issuance in the mining sector, just as an example of how you can also play the second derivative names in this space, in the services sector, and we like most ALQ and Mitchell Services in this space. Both are leveraged to the money raised by miners to then put into the ground in drilling and exploration. So those are the two that stand out for me. And just to wrap up all of the above, I've just listed 7 segments as to what looks most interesting in this space, and just some quick comments on some of the big ticket themes, if you like. BHP and Rio are at highs. They achieve those highs because they are disciplined with their capital these days, and more of that cash flow does get returned to shareholders. But just be aware that they are very reliant on what China decides to do or not on its policy regarding steel and iron ore. But certainly expect some more upgrades to flush through the market on those two stocks. We've talked about the energy sector. The gold sector's had a real pullback, and it does look like a compelling trade for insurance against market volatility. See Matt's calls on Ramelius and Regis there. Nickel stocks, nickel is one of the smallest base metals markets. It's one of the most capable of getting really silly. So not surprising that, the speculators are throwing a blanket over anything with nickel in it to try and play this momentum. Some of the ideas that stand out there include Strandline in industrial metals, Orocobre and lithium. and services stocks, as I've just mentioned. So there's a lot going on in this sector. It's making news daily. It's going to be one of the big themes of 2021.